Good morning. It's the 15th of November. We're coming up to the end of the year, and after the US inflation numbers came out, the market looks pretty fit actually after those numbers. But speaking of fit, let's kick it off with Viva Leisure. Stuart, these are girls in yoga pants, right? So I'll leave this topic to you.
Viva Leisure is a stock I've liked for a while now. It got slaughtered during the pandemic because gymnasiums were obviously closed. Now that it's opened again, Mark, do you like the picture of the lady in the Viva Leisure gym that I put on the left-hand side of this slide?
Definitely.
Right.
Next time we'll make it a bit bigger, that picture.
So now that COVID is over and people are looking to get fit, Viva are benefiting quite nicely from that. And there are some reasons why one should take a look at the stock right now, in my opinion. So let's take a look at what those are. There's the chart from recent days. Had a pretty good run up since earlier this year. Spiked in October, come back a little bit in the bearish conditions we're going through, but the general trend with this one has been up. Why do people like Viva Leisure so much? Well, it's the fact that they're a strong challenger brand in the gymnasium market. So Harry Constantinou, the man on the right-hand side of the screen, founded Viva back in 2004 in his native Canberra. They've now got 160 locations, some of them franchise, some of them corporate, throughout New South Wales, ACT, Queensland, Victoria, Western Australia. They've got the master franchise for another group called Plus Fitness, 175 clubs, Australia, New Zealand, and India. The most recent result was exquisitely strong, 141 million in revenue, up 55%. That's mostly organic growth, but obviously there's some COVID reasons why the 22 growth revenue wasn't so strong. EBITDA from a standing start gets to 29 million. What we're seeing at this result, and as well as a recent trading update, is that things just keep getting better for Viva in terms of occupancy, margins, other efficiencies, etc. So I think of this more as an organic growth story, but there's reasons why they can actually grow by acquisition as well. That's what the consensus numbers look like. There's your 141 million revenue for FY23. The consensus has them crossing the $200 million mark in revenue by about 2026. So when you compare that to EV to EBITDA numbers below 7, this stock looks like an outstanding buy in terms of the EV to EBITDA growth number. I think people are just a bit nervous. You've had small caps battered down in the worst bear market for small caps since 2002. And on top of that, you've got the reason I think the business isn't so well known. People assume that there's a gymnasium on every street corner. How can Viva be growing its business? The fact is, it's got a very strong brand, and the numbers are showing that it's continuing to grow that brand quite nicely. So the key with Viva is flexibility. There's multiple models, but you're not locked in forever in terms of whatever one you go with. Sometimes you're paying month to month, and they try and have low-cost operations rather than the more expensive ones. There's been a downturn in consumer confidence this year, as you'll be aware, because of inflation. That doesn't appear to have affected Viva at all. So basically, if you're a low-cost provider, you continue to do well. Meanwhile, the Commonwealth Bank has just voted strongly in favour of the balance sheet of this company by granting them some additional facilities. That'll fund new growth, potential acquisition growth, but also just organic growth with opening new gyms. It's fair to say that fitness is trending in Australia. We came out of COVID pretty unfit as a country, and people are aware of the fact that they've got to actually look after themselves. Mark, you and I both believe in physical fitness. You wouldn't know it by looking at my pretty ugly body, but we're part of that trend. I'm realizing I probably need to get out there and run a bit more than I usually do, or visit the gym. But it's a trend you're increasingly finding amongst all age groups, not just younger folks. But bringing it back to Viva, they just put out a trading update where they showed that their revenues in October were about 5% above June, so growing very strongly. Once you've fitted out a gym, it doesn't require much maintenance capex. The equipment just lasts a long time because it's made so strongly. And so the fruits of that is you get a lot of free cash flow from out of those gyms, and Viva's been investing those cash into new gyms, which you can acquire at very reasonable multiples compared to their own. So very accretive returns in terms of return on incremental equity for every new gym that they open up. And as I said before, the stock's undervaluing the growth potential. So I'm expecting for all these reasons that Viva will start showing up on a lot of radar screens, particularly for small cap institutional fund managers.
All right, Stu, if we go back to that price chart, and unfortunately we don't have the numbers for sort of COVID that period.
Right.
But if we were to zoom out, you can see that the share price was above $2, actually above $3, I think, around 2001. So
it wouldn't have gone back that far. It's only been listed for a few years now.
Yeah, so I think it goes back a couple of years, but it's well below where it was, sort of less than half of where it was just 2 or 3 years ago. But so what's the reason behind that? Because if everyone's coming back to the gym, why is Viva still half of what it was in terms of the share price?
Basically, it had the misfortune of coming on the market in June of 2019. So basically 9 months before COVID. These were good times for small caps. COVID was a wrenching moment for this company, because basically it couldn't do anything. You'd open a gym and have to close it straight away, and you'd be operating under the microscope in terms of people watching carefully how you were managing all those isolation type issues. When you have an event like that happen, it tends to knock around sentiment towards the stock, and I think that's what's hampered this company here. It's come out of COVID. It's operating pretty successfully according to a business model that they've proved up now for 20 years, coming out of the original gym in Canberra. But investors aren't willing to pay that premium with memories of what happened 3 years ago, is the way I would explain what's going on there.
Right. All righty. Yeah, look, I go to the gym. I go to Anytime Fitness. So it's I don't really like it, actually. It's boring as hell. But doctor says I have to go for knees and for the legs in general. It's very good for that. But it's usually pretty busy at Anytime Fitness. And like you said at the beginning, there's so many gyms in Australia. It's almost like, how is there space for a new operator, right? But apparently they can still carve out their little niche there.
Right.
Although it's not one of the bigger ones with 175 gyms, I guess. But that, I guess in itself, that is reason enough for growth, right? If you can just expand in areas where you're not yet present, in that sense, there's plenty of space.
Right.
But it looks like a little bit of a crowded market.
Right. Well, watch this space. I think there's plenty of growth where that came from.
All right. Well, then over to something completely different. Well, you touched on it a little bit, Stuart. Interest rates. If we look at what happened overnight in the US, inflation seems to be tamed almost, which has led someone to say, look, the Fed is done. And a lot of people are actually expecting that. But inflation came in below expectations. And so the market in the US was up. NASDAQ did quite well. So it looks like there's another round of high beta stocks that are really ready for a bounce back, I think. So let's just have a quick look at what those numbers were. So the US inflation came in below expectations for October. It was 3.2%, and the 3.3 was the consensus. Core inflation came in at 4, with 4.1 being the consensus. If you look at the chart there, we had a little bit of a run up in August and September, but you can definitely see the downtrend from last year in November, 7.1. Let's come all the way down to 3.2 now, and I think it's at least from the right trajectory, and that's coming down. So that's good news, and the markets liked it. Like I said, the equities markets rallied. The NASDAQ closed almost 2.5% higher, and even sort of the broader markets like S&P 500 and the NYSE composite up close to 2% or more than 2%. So market really liked it. Bond yields were coming down. So for the 10-year, it was in the US, it was the yields came down 20 bips, which is quite substantial for one day. So all in all, it looks like the market is getting ready for the second part of the interest rate cycle, which is the cutting. So if we look at next year, which if next calendar year, it starts in about 6 weeks, right? Most of the forecasters are predicting that the Fed will be starting to cut interest rates. And if you look at the Fed swaps, right now they're pricing in about a 50 basis point cut by July. So that's just 6-7 months from now. You get a 50 point cut. But UBS came out with their forecast earlier this week, and they're seeing the federal funds rate being cut by 2.75 to 2.75 basically by the end of next year. that is a massive cut, right? So that's not something that the market is pricing in. And some people are even predicting a deflation in 2024. So that will be something, right? Probably led by energy prices, if anything, if there's a let up in oil prices, for instance. But those are big calls to make. So even if you don't believe that, in general, the market is saying, look, we'll see interest rate cuts next year from modest to very substantial. So that's good news. And then looking at how the market responded to this. So if you look at this chart, you can see the peak of the NASDAQ in 2020, late 2021. And then that's come all the way down to the bottom, the circle at the bottom there, October last year. And Stuart, you may remember we spoke about this in one of our webinars that we'd seen the bottom.
Right.
So that's about a year ago. We had a double bottom, I should say. We've been on the uptrend, but lately the market has been a bit nervous, not really knowing what to sort of price in. But I think with the overnight numbers, you can clearly see all the way on the right of that chart that the NASDAQ is now trying to break out of that downtrend. So that's good. And I think looking at interest rates, if there's no black swans coming up in the next sort of 12 months, we should see rates coming down all the way through 2024. And I think that's great for the high beta stocks, technology, life sciences, all those sorts of industries that have been hit hard by the rising interest rates and the slowdown, especially in semiconductors, for instance, where there's a big slowdown in spending, as an example. And I recall, Stuart, one of the webinars we did either last week or the week before, where you showed the life sciences valuations and the biotech index, the NASDAQ biotech index, that had come down quite a way as well, right, in the last sort of 2 years. So I think those are the stocks that you need to look at. Load up on those cheap ones. Chip stocks, biotech stocks have been hammered because I think definitely from here on into the end of next year, we'll definitely see a re-rate of those stocks as interest rates come down. So on that bullish note, I think we'll end it. There's one more thing that we need to mention. We published a report on Freelancer this morning. Stuart, give us the elevator pitch on Freelancer. So today we published a research update. We've done the initiation a couple of months ago, but talk us through the story there in, say, 30 seconds.
Freelancer continues to benefit from the fact that freelancing is a thing across a vast swathe of the Western world. And the opportunity to grow that business is now being capitalized by Freelancer in a serious way. Throw in the fact that they also own escrow.com. So the number one regulated way in which people can put escrow big ticket transactions. And then the ability to then create individual verticals like load shift in the freight business says to me that this is a revolutionary company in the making. We'll be waiting a little while before the company really achieves its potential, but the most recent set of numbers are quite strong. And I think the once we get through the bear market of 2022-3, then this one's a candidate to recover because it's got plenty of cash to fund growth in the space that it actually leads.
All right, good stuff. We'll put the link at the bottom here so you can see where to download the full report. It's free to download. And on that note, Stuart, I think we'll wrap up and we'll see you all next week.
See you later.